Now, the inflation outcome had been widely expected by the local market, given global and local economic developments. Momentum Investments economist Sanisha Packirisamy discusses this with us. Thank you so much for your time, Sanisha. What does the CPI reading mean for consumers with the cost of basic food remaining high?
Thank you so much for having me. I think we need to take a little bit of a step back, looking at our local inflation in the context of what is happening in the global environment. And I think, South Africa has been bucking the trend for a number of months now in terms of inflation prints that have even come out below the bottom end of our 3 to 6% inflation target range. In many jurisdictions around the world, we've seen that the rate or the pace of disinflation, which is still positive inflation but falling, has been quite slow. And so we've seen that this last mile of disinflation, as they call it, has been quite slow in the context of rising protectionist measures such as tariffs and other non-tariff barriers. And so, in South Africa, I would say that we're actually coming off quite a low base. If we looked at the last 12-month period, half of the headline inflation prints that we've experienced since then have actually come out below that 3 to 6% band. As you mentioned, we've seen a bit of a blip higher on food prices, but I would say that the drivers behind food prices still suggest a modest outlook for food inflation for the remainder of the year. We've seen that on terms of the harvest expectations. We are likely to have a bumper crop this year, and together with well-behaved international food prices, this should keep a lid on average food inflation for 2025.
Given those dynamics, Sanisha, how then is the Reserve Bank expected to react to this inflation reading?
Expectations out there are quite split in terms of whether the Reserve Bank should act on these low inflation numbers and cut interest rates by another 25 basis points at the upcoming July Monetary Policy Committee meeting, whereas some analysts also believe that we need to take cognizance of the new pressures that have emerged in the Middle East and how that can relate to transport inflation and into our own basket here domestically, together with the potential for a lower inflation target. Of course, we know that that is really the decision of the finance minister at the end of the day, but that will also play a role in determining the amount of space that the central bank has in order to cut interest rates by responding to lower inflation. At the margin, we think that we are very close to the end of this interest rate cutting cycle, given that we've heard from the Reserve Bank why we do need a lower inflation target in SA. They've cited, lower risk premia, higher purchasing power, the potential for more investment in the long run in South Africa. And of course, that would then put a span in the works in terms of being able to cut interest rates by too far in South Africa.
As a parting shot, what could change that near-term outlook, particularly where CPI in relation to interest rates is concerned?
At the moment, we've got this perfect storm of factors that are contributing to low inflation in South Africa. Even though we have seen conflict between Israel and Iran, the global price of oil, I would say, has been reasonably capped. And I think that's because OPEC supply could potentially still offset any drying up of supply coming through from Iran. Secondly, our rand dollar exchange rate has also been relatively well behaved, even in the context of, the risk off kind of atmosphere in the global economy. We've seen that rental inflation in South Africa, which is about 15 or 16% of the consumer price basket, has been trending below 3% in year-on-year terms now for 12 months running. And so many of the factors within our inflation basket have been at the lower end, coming through there. So we have actually had quite a favorable boost in terms of that coming. But where the risks lie, I would say that international prices of oil are still at risk with the potential escalation in the conflict between Israel and Iran. Although we don't think it's likely at this stage, if Iran had to decide to close off the Strait of Hormuz, about 30% of global international oil supply goes through that strait, and that would then put significant upward pressure on the international price of oil. And that, of course, would then feed through directly into our South African consumer basket via the transport and fuel channel.
And we don't need that, especially because fuel was a relief this time around in the inflation data. Thank you so much for your input. Momentum Investments economist Sanisha Packirisamy adding her reaction to the latest inflation figures.